does it come back to easing back all the free money, all the cheap free liquidity that we've gotten, and then maybe 15% is more achievable, like you said, maybe even on an unlevered basis?
Yeah. Well, look, there are people who think that the Fed will keep rates low forever, and that will produce a prosperous economy and rising markets forever. I don't believe it. So, and I hope, look, we're all on this call and we're all in this business because we believe in the free enterprise system. And, when I went to Chicago, Milton Friedman was all the rage. And of course, he got famous, and the Chicago School of Economics got famous for saying that the free market is the best allocator of resources. It moves resources to where they'll do the most good. And I think we all agree with that. But we don't have a free market in money. And I think we should have it because it'll do a better job. Now, they had to cut rates and buy bonds and force pump liquidity into the system in 20, or we would have had a global depression. I'm sure of that. But now that it's over, they should let go of their control. And I'd like to see a free market in money. And if we get a free market in money, then I believe eventually rates will rise somewhat. Inflation will probably be higher in the coming years than it was in the last 10 or 15. And if rates go up, that means asset prices go down. My partner Sheldon Stone has been my partner since '83, my longest running partner, and he runs the high yield portfolios at Oaktree, and he goes around all day doing this. Right, rates up, prices down.
Mm-hmm.
Rates down, prices up. It's got that down pat, and that's the way it works. And in our world of debt or fixed income, it's really a mechanical relationship. It's the same relationship in all other forms of investing, but not mechanical. But I think that one of these days, inflation will be established to be higher than it has been. That'll cause rates to go up.
How much higher?
Oh, I'm going to tell you what I said to that older lady. I don't know anything you don't know. But having said that, the easy thing to say is 3 to 4%. Why is it so easy? Well, it's hard to say we're going back to 1, where we've been for the last 15 years, and it's hard to say it's going to stay at 6. It's easy. The middle of the bell-shaped curve is to say 3 or 4, but that doesn't mean that it has any higher probability of being correct.
Should the Fed then be moving faster than they are and ease up on the free money and let investors have access to free markets? Well,
despite what I might say, they know more about their job than I do. But I mean, I think they were too slow in the last decade, and I'd like to see them move. And I don't see why it has to take a year to undo stimulus. And I think that they cut rates, and the Treasury involves in deficit spending in a Keynesian sort of way in order to support an economy which is not growing fast enough to create jobs. That's the job of the Fed. Once the economy is growing well, I think they should take off the training wheels. And so again, I'm not an economist, and I'm not a Fed expert, but I would have thought that it would have been great if they would have raised rates in 13, 14, 15, when the recovery was young, relatively young, and spirited. And so I think that our economy is doing well, and I think that these things should be in the process of being reversed right now.